What if I told you the wrong choice between mutual funds and ETFs could quietly drain thousands of dollars from your future wealth? And here's the thing. Most beginners have no idea they're making that mistake. Today, you'll finally uncover which one really fits you best. And the answer may surprise you. Number 1. Why this decision matters more than you think. You might wonder, what's the big deal? After all, both mutual funds and ETFs help you invest in a bunch of stocks or bonds at once. But here's where it gets tricky. One of them could eat up your returns with sneaky fees, while the other might leave you exposed at the wrong moment. For example, take Sarah, a teacher who started investing through a mutual fund her bank recommended. She thought she was being smart, until she noticed years later that the fees had quietly eaten away more than 20% of her gains. On the other hand, her brother Jack picked an ETF and enjoyed lower costs and more flexibility. That difference added up to thousands of dollars. So, yes, this choice really does matter. Number 2. What exactly is a mutual fund? Let's keep this simple. A mutual fund is like a big pot of money collected from thousands of investors, managed by a professional. That professional decides what to buy and sell. You don't have to think about it. They do it all for you. You invest your money, and at the end of each day, the fund calculates the value of your share. Here's an example. If you invest $500 into a mutual fund that focuses on large U.S. companies, your money is spread across giants like Apple, Microsoft, and Google. The upside? It's hands-off and great for people who don't want to monitor the stock market. The downside? That professional manager doesn't work for free. Mutual funds usually come with higher fees, called expense ratios, and sometimes sales commissions, called loads. These can quietly chip away at your returns over time. Number 3. What is an ETF, anyway? Now, let's talk about ETFs, exchange traded funds. An ETF is similar to a mutual fund because it also holds a basket of investments. But there are big differences. First, ETFs trade on the stock exchange, just like individual stocks. That means you can buy and sell them anytime during the trading day at a price that changes constantly. For example, you could log into your brokerage account at 10 a.m., see that an S&P 500 ETF is trading at $450 per share, and buy it right then. You don't have to wait for the end of the day like with mutual funds. And here's another win. Most ETFs are passively managed. That means they just follow an index, like the S&P 500, with no expensive manager calling the shots. So ETFs often come with much lower fees. Number 4. Liquidity. Why timing matters. Have you ever needed your money quickly? This is where ETFs have the upper hand. Because ETFs trade like stocks, you can sell your shares instantly during market hours. For example, if you're saving for a down payment and suddenly find your dream house, you can sell your ETF right away to get the cash. With mutual funds, though, you can only sell at the end of the day. That might not sound like a big deal until you're in a fast-moving market or need the money in an emergency. Number 5. Taxes, the hidden trap. Here's a fact most beginners don't know. Mutual funds can surprise you with a tax bill. Why? Because the fund manager might sell stocks at a gain inside the fund, and you get stuck paying taxes on your share of those gains, even if you didn't sell anything yourself. This is called a capital gains distribution. For example, even if your mutual fund dropped in value for the year, you could still owe taxes if the manager sold some winners. On the other hand, ETFs are generally more tax efficient because of the way they're structured. You're more in control of when you sell and trigger a taxable event. That can save you money at tax time. Number 6. Fees, the silent killer. Let's talk about something that drains your money without you even noticing. Fees. Mutual funds often have higher expense ratios, sometimes over 1% per year. That might not sound like much, but on a $50,000 investment, that's $500 every year, and it compounds over time. Some mutual funds even charge a sales commission, called a front-end load, which can be as high as 5% when you buy. That means if you invest $10,000, you could lose $500 right out of the gate. ETFs usually have much lower fees, often just a fraction of a percent, and no sales commissions if you buy them through most online brokers. That's money that stays in your pocket. Number 7. Accessibility. How easy is it to start? One of the reasons people choose mutual funds is because they're easy to set up through a bank or retirement plan. You can even set up automatic monthly contributions. For example, your 401k at work probably offers mutual funds. On the flip side, ETFs are just as easy if you already have a brokerage account. In fact, apps like Robinhood or Fidelity let you buy ETFs with just a few taps. And you can even buy fractional shares of ETFs if you don't have enough for a full share. That makes ETFs more accessible for beginners who want to start small. Number 8. Active versus passive. Who's driving the car? Here's a fun way to think about it. Mutual funds are like hiring a chauffeur. Someone else drives you around and decides the route. That's active management. ETFs are usually like using a GPS. You still follow a set route, but you're in the driver's seat. That's passive management. Over the long term, research shows that passive strategies, like those used by ETFs, often outperform expensive, active managers. So unless you truly believe your fund manager can beat the market, an ETF might give you better results for less money. Number 9. Which one should you pick? So which one is better? Here's the honest answer. It depends on you. If you like a hands-off approach, want help making choices, and don't mind paying extra for it, a mutual fund might fit you. If you want flexibility, lower costs, and more control, ETFs could be the smarter choice. For example, someone saving for retirement through a 401k might stick with mutual funds, but someone building a taxable investment account could prefer ETFs for their tax efficiency. And here's the secret. You don't even have to pick just one. Many investors use both in different accounts depending on their goals. Number 10. Long-term versus short-term goals. Does it even matter? Believe it or not, your timeline plays a huge role in this decision. If you're saving for something far in the future, like retirement, you might not care about daily price fluctuations. That's where mutual funds shine because you can just set it and forget it. For example, Laura, who's in her 30s, invests automatically into her employer's mutual fund through her 401k. She never looks at it, and 20 years from now, she'll have a solid nest egg. But if you're saving for a shorter-term goal, like buying a house in 3 years, an ETF might give you better control and instant access when you're ready to sell. That flexibility can be a real lifesaver when timing matters. Number 11. Minimum investments. How much do you need to start? Here's another surprising difference. Many mutual funds require you to invest a minimum amount up front, sometimes $1,000, sometimes even $3,000 or more. That can feel like a huge barrier if you're just starting out. ETFs, on the other hand, don't have minimums. You can buy as little as one share, or even a fraction of a share if your broker allows it. For example, if an ETF trades at $200 and you only have $50, many platforms let you buy just a piece of it. That makes ETFs a great way for beginners to dip their toes in without waiting to save up a big chunk of cash. Number 12. Who are you trusting with your money? This might sound obvious, but it's worth saying. When you invest in a mutual fund, you're trusting a manager and their team to make decisions on your behalf. That can be comforting to some people, but it can also backfire if the manager makes bad calls. For example, during the 2008 financial crisis, many actively managed mutual funds performed worse than the overall market, even though investors were paying those managers hefty fees to beat the market. On the flip side, ETFs simply follow an index. No emotions, no guessing. It's just math. That predictability appeals to many people, especially beginners. Number 13. How often do you want to check? This might surprise you, but mutual funds and ETFs can even affect how you behave as an investor. Mutual funds don't change price during the day. They're only priced at the close of the market. That makes them less tempting to watch constantly. But ETFs, because they trade all day, can lure you into checking your account too often or making emotional trades when prices jump up or down. If you know you're the kind of person who might panic and sell at the wrong time, sticking with mutual funds could help you avoid that temptation. For example, Mike bought an ETF and couldn't stop refreshing his app every hour and ended up selling at a loss during a short-term dip. If that sounds like you, think carefully about what fits your personality. So now I want to hear from you. If you had to pick right now, would you go with the hands-off simplicity of mutual funds, the flexible and low-cost nature of ETFs, or a little of both? Drop your answer below, and don't forget to share why you chose it. I'd love to read your take on it.